What if the next financial crisis did not just hurt investment portfolios, but permanently rewrote the very rules of money as they are known today? This is the question that many analysts prefer to ignore, yet the year 2026 is shaping up to be the moment when everything changes. Unlike 2008, there is no miraculous rescue plan waiting to contain the fall. In this profound analysis, the technical reasons why the global system is on an inevitable collapse trajectory will be exposed, and more importantly, a clear roadmap will be provided to identify the warning signs before it is too late. The global financial architecture is at a turning point that threatens to fracture the very foundations of the monetary system. There is a widespread perception that economic crises are isolated events, temporary systemic failures that can be corrected with timely intervention by regulatory bodies. However, a rigorous analysis of debt cycles suggests that the world is approaching a moment when the traditional rules of money will no longer be applicable. The year 2026 is emerging not as a repetition of habitual market corrections, but as the culmination of a decades-long debt supercycle. The structure upon which trust in central institutions is built faces its most critical challenge today, and unlike what happened in 2008, where the risk was localized in specific assets, the current vulnerability is systemic, profound, and multidimensional. To understand the magnitude of the approaching threat, it is imperative to precisely analyze the events that marked the collapse of September 2008. The fall of Lehman Brothers was not simply the bankruptcy of a top-tier investment bank, but the exposure of an architecture of toxic assets that had infected the balance sheets of the world's leading financial institutions. At that time, the immediate debt at risk amounted to $600 billion, a figure that, while shocking then, pales today compared to current leverage levels. The response from central banks was the implementation of an unprecedented, ultra-expansive monetary policy. The Federal Reserve of the United States aggressively reduced interest rates to near-zero levels and introduced quantitative easing, allowing for the printing of trillions of dollars to sustain asset prices. This intervention managed to avoid an immediate depression, but it carried a hidden cost that most analyses deliberately omit. The problem of solvency was not solved. Rather, it was transformed into a problem of massive, artificially sustained liquidity. Failed institutions were allowed to survive under the support of public capital, transferring risk from the private sector to sovereign state balance sheets. For the past 2 decades, the system has lived under the mirage of a sustainable recovery, when in reality it has been dedicated to postponing the inevitable accumulating a debt burden that has grown at a rate far exceeding that of real productivity. The result is a financial ecosystem that requires ever-increasing doses of monetary intervention to stay afloat, a dynamic that will finally find its mathematical limit in the year 2026. The figures describing the current state of global indebtedness reveal technical unsustainability. In 2008, the planet's total debt stood at $142 trillion. Today, that figure has escalated to over $251 trillion, representing an increase of more than 77%. To put this in perspective, it is necessary to observe that global gross domestic product growth over the same period has barely touched 40%. The technical conclusion is inescapable. The world has borrowed money at twice the speed it is capable of generating real wealth. The global debt-to-GDP ratio now stands at 235%, a level that historically precedes major processes of forced restructuring or massive monetary devaluations that alter the established order. The most critical aspect of this financial burden lies not only in the principal capital but in the growing cost of debt service. With the return of higher interest rates to combat structural inflation, the annual cost of interest payments has surpassed $10 trillion. This sum is greater than the combined size of the economies of Germany and Japan. Every monetary unit used to pay interest is a resource withdrawn from productive investment, infrastructure, or social welfare. This fiscal suffocation is what is draining the vitality of developed nations. The United States leads this trend with a public debt exceeding $38 trillion, implying that the solvency of the world's primary economy is now under a questioning that markets are only beginning to process. A determining factor that is often ignored is the state of the commercial real estate sector. This market, which was historically the safest haven for institutional capital, now faces its greatest challenge since the Great Depression. The profound shift in work patterns and accelerated digitalization have left major urban centers with oversized and obsolete infrastructure. Office vacancy rates in global metropolises have reached record levels, standing near 20%. The problem is not only the lack of tenants, but the financing structure sustaining these assets. Unlike the residential market, the commercial market relies on short and medium-term loans that must be constantly refinanced under current market conditions. During the course of 2026, debts worth approximately $930 billion linked to office buildings and shopping centers will mature. These loans were originally issued under near-zero rate conditions and peak market valuations. Upon attempting refinancing, owners find that their buildings have lost nearly 40% of their projected value, while the cost of new financing has tripled. This mismatch creates a capital hole that the regional banking system will find difficult to absorb. It is estimated that hundreds of financial institutions possess exposure to commercial real estate risk that doubles their capital reserves, which will generate a domino effect on small and medium-sized banking, freezing the flow of credit to the real economy and triggering a recession from the system's foundations. It is necessary to delve into the mechanics of the real estate collapse, as it is not an isolated event. The interconnection between pension funds, insurance companies, and bank balance sheets means that the drop in office values in Manhattan, London, or Tokyo is a global problem. When an investment fund sees its real estate portfolio depreciate, it is forced to sell other assets, such as stocks or bonds, to maintain its liquidity levels. This forced liquidation process is what moves the crisis from the real estate sector to the entire stock market. In 2026, we will witness the largest revaluation of physical assets in modern history, where what was previously considered solid will be revealed as an unsustainable liability. Simultaneously, the economic engine that sustained the world for the last few decades shows unequivocal signs of exhaustion. China's growth model, based on massive investment in infrastructure and housing, has reached its terminal limit. The Chinese real estate sector, which represented about one-third of its national economy, is now in a state of paralysis. The drastic fall in property sales is not a temporary event, but a structural transformation driven by demographic factors and an excess of housing supply. As a result, a China that does not consume is a China that does not import raw materials, directly affecting natural resource exporting nations across the planet. The interconnectedness of the supply chain ensures that the Chinese economic slowdown translates into a drop in corporate profitability throughout the West, increasing pressure on global stock markets. But the Chinese crisis goes beyond empty buildings. It is a crisis of its shadow banking system and local government financing vehicles, which have accumulated massive debts to finance infrastructure projects that do not generate economic returns. When these vehicles stop paying their obligations in 2026, the Asian financial system will face a solvency crisis that will force a massive devaluation of the yuan. A weaker Chinese currency will export deflation to the rest of the world, destroying the profit margins of manufacturing industries in Europe and America, and exacerbating trade tensions that are already at critical levels. The third major fracture is located in the government bond market. For years, the premise was that there would always be demand for sovereign debt regardless of deficit levels. However, currently, institutional investors are beginning to demand significantly higher yields to compensate for the risk of debt that appears to have no ceiling or control. 61 developing nations already allocate more than 10% of their fiscal income exclusively to interest payments, eliminating their ability to respond to any economic or social eventuality. Even in the most advanced economies of Europe, the cost of refinancing existing debt has become prohibitive, forcing governments to make drastic cuts in public spending at a time of economic fragility, which accelerates the entry into a prolonged recession cycle. This phenomenon, known as the return of bond vigilantes, implies that financial markets have taken control of the fiscal policy of nations. If a government tries to spend money it does not have to rescue its population or its banks, the bond market reacts by raising interest rates, which instantly increases the cost of the country's entire debt. It is a mathematical dead end. In 2026, we will see nations considered too big to fail facing deserted bond auctions, where no one wants to lend money to a state that clearly cannot repay it. This will mark the end of the era of the debt-funded welfare state and the beginning of an era of forced austerity and massive social discontent. Added to this landscape is the fact that central banks have exhausted practically their entire intervention arsenal. In 2008, the Federal Reserve had considerable room for action to cut interest rates and stimulate the economy. Today, after years of fighting persistent inflation, rates are at a level where an aggressive cut would simply destroy the value of the currency without generating real growth. Central institutions face an impossible dilemma. allow the financial system to collapse to clear the accumulated excess debt, or print money to save it, causing hyperinflation that would destabilize the social order. Quantitative easing has lost its effectiveness after 4 rounds of massive injections, and any new intervention could be interpreted by markets as a final act of desperation. It is important to understand that current inflation is not a passing phenomenon, but the result of decades of unbacked money creation and the breakdown of global supply chains. Central banks are trapped. If they raise rates to curb inflation, they bankrupt the financial system and the real estate market. If they lower them to save the banks, inflation skyrockets, destroying citizens' purchasing power and provoking social revolts. In 2026, this contradiction will reach its critical point, revealing that the monetary emperor has no clothes, and that faith in fiat money is the only thread holding the current system together. Geopolitical instability acts as the ultimate catalyst for this crisis. The era of fluid globalization has been replaced by a fragmentation of economic blocks in open conflict. International tensions interrupt trade routes, increase energy costs, and hinder access to critical minerals for modern technology. This inevitably leads to an environment of stagflation, where economic activity contracts while prices continue to rise due to external factors that traditional monetary policies cannot control. Stagflation is the most destructive scenario for wealth preservation, as traditional investments in stocks and bonds usually lose real value simultaneously, leaving few safe havens for capital. Geopolitical fragmentation also means that, unlike 2008, there will be no coordinated global response. In the previous crisis, G20 powers joined to inject liquidity and stabilize the system. In 2026, each bloc, the United States, China, Europe, and the Global South, will try to protect its own interests at the expense of others. We will see the use of the financial system as a weapon of war, with sanctions, reserve freezes, and the creation of alternative payment systems that will definitively fracture the global market. This lack of international cooperation ensures the crisis will be deeper, longer, and much more chaotic than any event lived through in the modern era. It is fundamental to consider the technological variable and the speed of capital in the age of artificial intelligence. Unlike previous crises where bank panics developed over weeks, today confidence can evaporate in seconds. High-frequency trading systems execute massive sell orders at the slightest sign of instability, amplifying market drops instantaneously. The digitalization of financial panic drastically reduces the ability of regulators to intervene effectively, as collapse can occur in hours, even before rescue plans can be designed. Imagine a scenario where an algorithm detects a rumor about the insolvency of a major regional bank. In milliseconds, millions of shares are sold, the price plunges, and depositors, alerted by notifications on their phones, withdraw their funds digitally in minutes. By the time the bank opens its physical doors the next day, it no longer exists. This is the reality of 2026, a crisis moving at light speed, where human reaction time is simply too slow to stop the financial hemorrhage. Given the convergence of these factors, it is possible to project 3 distinct paths for the global economy in the short term. The scenario of a soft landing has a reduced probability of 20%, as it would require a miraculous increase in productivity driven by artificial intelligence to compensate for the weight of accumulated debt. The most likely scenario, with a 55% probability, is that of a rolling crisis, characterized by sequential failures in regional banking and the corporate sector, leading major powers into a painful and prolonged recession lasting several years, with market drops of up to 35% and a significant increase in unemployment. Finally, there is a 25% probability of a total systemic collapse. This would occur if several of the mentioned triggers, sovereign debt, real estate collapse, and a major geopolitical conflict, hit at the same time. In this case, the value of traditional financial assets would evaporate, forcing a total replacement of the current financial system with new structures, likely central bank digital currencies that would allow total control over consumption and citizen privacy. This would be the financial Great Reset, an event that would change the structure of society as it is known. To navigate this environment of uncertainty, 10 fundamental metrics have been identified that serve as an early warning system for any individual responsible for their financial future. It is necessary to monitor the exchange rate between the dollar and the yen, as it is the primary indicator of global liquidity. If the yen strengthens sharply, it is a sign that panic has begun. The yield on 10-year Treasury bonds is another critical metric. An increase above 5% indicates the system can no longer support the weight of its own debt. Credit spreads, which measure corporate risk, signal the proximity of a wave of corporate bankruptcies when they begin to rise aggressively. The performance of regional banks must be closely monitored, specifically through exchange-traded funds such as the KRE, as they are the weakest link in the current credit system. Similarly, China's manufacturing index provides a clear view of whether the engine of world trade is stopping. The VIX volatility index, known as the fear index, signals when the market has entered a phase of irrational panic. The real unemployment rate, delinquency in commercial real estate loans, and the inversion of the yield curve are infallible recession signals. Finally, the Buffett indicator, which compares stock market value with the size of the real economy, shows the magnitude of the bubble about to burst. If this indicator is above 200%, the fall will be historical. The technical conclusion of this analysis should not be interpreted as alarmism, but as a call for strategic preparation. Financial history demonstrates that those who identify the cycle change before the consensus are the ones who manage to protect their wealth and secure their future. Implementing a defensive strategy requires increasing available liquidity, accumulating cash savings that cover at least 12 months of expenses. It is also vital to diversify into real assets, such as gold or productive real estate outside urban centers, which historically preserve value against inflation. It is imperative to eliminate all debt with variable interest rates, as in a volatile environment, payments can skyrocket overnight, leading to personal or business bankruptcy. Understanding the mechanisms governing today's macroeconomy is the only way to act with calm and rationality, while the rest of the market participants react by instinct. Human resilience is enormous, and societies always adapt and recover. But the 2026 adjustment process will be exceptionally painful for those who are not prepared. The world faces a historical challenge that will test the resistance of our economic and social structures. Rigorous monitoring of data and objective analysis of facts are the only pillars of security in an age marked by transformation and uncertainty. Those who ignore the warning signs, who prefer the comfort of denial, will find themselves unprotected before an unprecedented economic storm. Information, today more than ever, is the most powerful defense tool. Staying informed about the monthly evolution of these 10 strategic indicators will be the difference between capital preservation and irreversible loss of wealth. Deep gratitude is expressed for the attention dedicated to this exhaustive report. Knowledge is not just power, it is financial survival. In the next installment of this analysis, the capital movements that major wealth management institutions are currently performing silently will be explored in detail, including the safe haven assets the ultra-rich are accumulating to protect themselves against the scenario of prolonged stagflation and a possible change in the international monetary order. Deep understanding of these phenomena is essential for successfully navigating the new financial landscape that will emerge after the collapse. Thank you for joining us on this journey through the reality of the global economy.